Hello, John Price here, and I'm joined by Nick Guidera, Portfolio Manager of the Emerging Companies Fund. Nick, Smalls and Emerging Companies Fund have enjoyed a renaissance of late. Can you just run us through some, what are some evidence of that?
I think, John, as at the middle of October, the small cap or the small ordinaries is in a technical bull market, which means it's up more than 20% from the lows that we saw in October 23, which was a pretty dark time. In that month, the small ords was down more than 5%, and there was question marks as to whether the Fed would cut rates. A couple of days after that month finished, we got the signal, and the rest is history. I think there's some other evidence out there that small caps is enjoying a bit of a renaissance. Firstly, capital markets very much are open. I think as at the end of last week, over $9 billion had been raised in follow-on deals since the 1st of July, with the average stock that raised more than $30 million being up up 15%, I should say, from that placement price. So there's definitely been money being put to work in small companies as companies come and seek more capital from investors. Probably the other thing that sort of remains a little bit dormant is the IPO pipeline. Despite a lot of hope that IPOs would come and a really strong market backdrop, we're yet to see too many ideas as yet.
Yeah. Okay, let's stay on IPOs because I know the Emerging Companies Fund played in GYG. Can you talk us through that?
Yeah, so Guzman and Gomez was a really controversial stock for IPO and now stock has been for some time. I think largely due to the valuation that the market had some concerns over. In saying that though, it was one of the few companies with a really strong management track record that had overinvested in their support network to be able to provide growth to their franchisees and corporate stores with a genuine rollout opportunity that's roughly a fifth of the size of a McDonald's footprint in Australia. And a franchise relationship which to date has appeared relatively healthy. There's no captive sales that franchisees are required to make from Guzman in food. They're not trying to make margin in different ways. I think they've worked out the franchise model. They've got a long runway ahead of them, and we're one of the few funds to back it at the IPO. We certainly thought it was expensive, but what we've realised is that the market is willing to pay up for visibility on those structural growth runways. At the same time, the scarcity that exists in this area of the market where you don't necessarily have that kind of strong rollout opportunity, and also an embedded earnings growth through new stores that will open, and an overinvestment in support that should mean that margins could tick up over time.
Yeah. Okay, let's move now to your travel diary. You've been on the road for probably the last month. So what were some of the key points from that trip?
So I've done Victoria, I've done Queensland, and I've also been to Long White Cloud in New Zealand. Probably New Zealand's probably the most interesting in that they're in the middle of a recession. They've got a OCR or an RBA rate equivalent that's higher than where Aussie is at the moment. They've just seen two 25 basis point cut and a 50 basis point cut in the last couple of months, and there's expected there'll be more cuts to come. It certainly feels pretty bad over there at the moment, not surprisingly, because they're in the middle of a recession. But there was some green shoots that the confidence was coming back to business, and you'll start to see a reinvestment cycle going forward. I think as a general comment, the Australian companies are definitely doing slightly better than perhaps the market had expected. You're still seeing pockets of weakness here and there, but to give you an example, you've seen a number of retailers release trading updates in the last week or so that suggest that trading has improved, particularly those that are housing exposed. Company like Adairs and Beacon Lighting and Nick Scali also all noting improved trends in sales from here. I think as a general comment, we should be able to muddle our way through this challenging period of time, assuming everyone remains in a job. I think the other tailwind for Australia is demographics, which has continued to kind of support the consumer as baby boomers are retiring with a large amount of household wealth and are looking to deploy that spend into the economy and providing a support at a time when mortgage holders are probably under a substantial amount of stress. Plus, you've got the opportunity of further rate cuts in the next within the next 12 months, which should provide further easing for consumers that are under pressure that potentially own a home.
Yeah. So business confidence, consumer confidence is okay. Interest rates coming. How are you positioned with all these things, taking all these things into consideration?
We've said for some time that you need to have a diverse portfolio and you haven't been paid to take bets in one direction or another. I think at the margin that's starting to change. I think what you're seeing in the last couple of months in a new monetary policy environment where you've got rate cuts across the world and likely rate cuts in Australia, that the need for incremental monetary support will provide a decent amount of tailwind for companies that perhaps have suffered from higher interest rate environments or a challenged consumer. So I think what you are seeing is people chasing opportunities to put capital to work. The stat I gave earlier in relation to the number of capital raises, people are looking for ideas. So the breadth of the portfolio needs to expand. In the last couple of years, there's been a lot of people concentrated in quality names because quality's looked after you in an environment where it's been relatively uncertain. But in the next 6 weeks, we're going to have more rate cuts, and we're probably going to find out who the next US president's going to be, which the market will be able to price and move on from that. If you look at the earnings expectations for small caps relative to large caps in the next calendar year, 25 versus 24, there's a massive differential. And I think what that will mean is you'll see large cap investors start to come into small caps and emerging companies and look for the next best growth story. And I think you're already seeing that, and you're seeing some of these emerging companies moving substantially higher in a short amount of time as the illiquidity kind of drives those stocks higher. But from a portfolio perspective, what we're trying to do is have a good bunch of fundamental stock ideas that can still take advantage of an improving economic backdrop, an improving consumer, but fundamentally have an investment thesis that is independent of the macro. Because I think those days of 2 years ago where macro was dominating every investment conversation will largely take a back seat, and investors will be scrutinising earnings and valuations far more in 25 than they have for a long time. And I think small caps relative to large caps certainly looks like the place where people will be hunting.
Thanks, Nick. Thanks for your comments about the backdrop for investing in emerging companies and sharing what's actually happening in the portfolio. Thank you for watching, and if you've got any further questions, please reach out.